Listen, I'm about to tell you something the banks don't want you to know. Quick note, this is Jeremy McDonald's AI twin. Jeremy personally writes every script and reads every message you send. He's helping home buyers, homeowners, investors, and real estate agents across Florida and 48 states. Now let's get into it. Here's what your bank will never tell you about buying a home in 2026. They've already decided what they want to loan you before you even walk in the door. And it's not because you don't qualify. It's because their pricing model says you're worth less to them than the guy next to you. Banks operate on one model. They take your application, run your credit, check your income, plug you into a formula. Out pops a rate. And that rate is based on what you look like to their algorithm, not what you actually qualify for in the market. I worked for national banks for 15 years before I went independent. I've seen the overlay sheets. I've watched them repricing the same borrower depending on the day of the week. It's not illegal, it's just how they work. Here's what changed in 2026. Interest rate environment shifted. Fed's holding steady. Treasury bonds are trading in the high fours. That means mortgage rates are the best they've been in 2 years. But banks aren't passing that along equally. Why? Because they don't have to. They've got customers locked into their ecosystem. Checking account, savings account, auto loan. You're not shopping around. Here's what I'm telling my clients right now. Brokers like me have access to over 240 lenders. That means your rate isn't locked into a formula. It's locked into the actual market. Same credit score, same down payment, same debt. You could walk out of a bank at 6.75 and walk into my office and get 6.38. On a $400,000 loan, that's $200 a month in your pocket. Over 30 years, that's $72,000. I've been in the mortgage business since 2003. Started at national banks. Moved to the broker world because I got tired of watching them tell good people no, when the answer was actually yes. I've got a $1,000 lowest rate and fee guarantee. You find a better rate with the same terms, I beat it or write you a check. Banks don't offer that because they can't. They're not hungry. They don't have to be. Now, if you're a first-time buyer in 2026, you've got 4 solid paths forward. FHA, VA, USDA, conventional. They're not all equal. And most banks will steer you toward the one that makes them the most money, not the one that saves you the most money. In the next part, I'll break down which loan program actually makes sense for your situation. Okay, so we talked about why banks are keeping you from better rates. Now let's talk about which loan program is actually right for you if you're buying in 2026. And spoiler alert, it's probably not the one your bank is pushing. Let's start with FHA. This is the most popular first-time buyer program. And here's why. It's flexible. Credit score? 620 gets you approved. Down payment? 3.5%. That's $15,000 on a $400,000 house. No asset requirements, no crazy debt-to-income limits. They'll work with you. Here's the catch. You're paying mortgage insurance, both upfront and monthly. Upfront MIP, that's mortgage insurance premium, is about 1.75% of your loan amount. Monthly MI is about 0.85% annually of your loan amount. So on a $400,000 loan, you're paying roughly $250 to $300 a month in insurance. And you can't remove it until you've got at least 20% equity. FHA is great if you've got challenged credit or minimal savings. But if you've got a decent credit score and can scrape together a bit more down payment, keep listening. VA loans are the best kept secret in real estate. And I say that as someone who doesn't even qualify for one. 0 down, 0 PMI, best rates available. If you served, this is your program. The VA doesn't charge mortgage insurance because they're backing the lender. Your only cost is a funding fee, which is 1.57% on your first use. That gets rolled into your loan. You pay it over time, and you can remove it if you ever refi into a conventional. Here's the truth about VA loans. Banks hate them because they can't mark them up. The rates are standardized. The terms are standardized. Brokers like me, we love them because we can shop them across multiple lenders and get you the absolute best deal. VA loans are closing faster in 2026 because rates are better. We're seeing lock to close in 14 to 18 days. If you served, you are leaving money on the table if you're not looking at a VA loan first. USDA loans are the underdog program, and almost nobody talks about them. Here's who they're for. Anybody buying in a rural or suburban area with income at or below 145% of your area's median income. No down payment required, no mortgage insurance, better rates than FHA. The catch? They take longer to process because of the rural designation paperwork. USDA is the program I tell people about and watch their eyes light up, because most brokers and banks don't know it as well. But if you're buying in Northeast Florida outside the urban core, or anywhere across the country in a rural area, USDA is worth exploring, especially if you don't qualify for VA. Conventional is the traditional path, 3% down on most programs if you've got decent credit, 3.5 to 5% if your credit's lower. No mortgage insurance if you put down 20%. MI if you put down less, but it's removable once you hit 20% equity. Conventional has the lowest rates if you've got solid credit and can put down at least 3%. But here's the thing, conventional doesn't care about making your life easy. They want debt-to-income ratios under 43%, sometimes lower. They want 2 years of tax returns, 2 months of bank statements, asset verification. FHA, VA, USDA, way more flexible. So here's how I break it down for first-time buyers in 2026. If you served, VA, no question. If you've got challenged credit or minimal savings, FHA. If you're buying rural and your income fits, USDA. If you've got solid credit and 3% minimum down, conventional. But here's what your bank won't tell you. Just because you qualify for one doesn't mean it's the best one for you. I run first-time buyers through all 4 scenarios and show them the actual monthly payment difference. In the next part, I'll tell you exactly what we're looking at when we pull that soft credit. All right, so we've covered the 4 loan programs. Now let's talk about what happens before you're actually approved, the soft credit pre-screen. Here's what banks don't tell you. When you apply for a mortgage, your first instinct is, they're going to pull my credit and see my score. True, but here's what they don't tell you. A hard credit pull actually damages your score. Each hard pull dings you 5 to 10 points. And if you're applying at 3 different banks, that's 30 points off your score, right there. So smart brokers, we run a soft credit pre-screen first. It's not a hard pull, no impact on your score, no inquiry recorded. It gives us the exact same information about your credit health without damaging the score itself. Here's what we're actually looking at on that soft credit. 1, your credit score, obviously. 2, your open accounts. 3, your payment history. 4, your collections or charge-offs. 5, your inquiries. How many times you've applied for credit recently. On that soft credit, we're looking for 5 specific things that kill deals. Recent late payments. Anything 30 days late in the last 12 months is a red flag. 60 or 90 days late. We've got to explain it. Open collections. If you've got a $400 medical debt in collections, that's a problem. But here's the inside information. Medical debt is different. We can work with it. Credit card collections, utility collections, tougher to explain. Recent inquiries. If you've got 8 hard inquiries in the last 30 days, it looks like you're desperate for credit, and lenders get nervous. High balances on revolving accounts. If you've maxed out your credit cards, your debt-to-income ratio is going to blow up. Bankruptcy or foreclosure in the last 2 years. Automatic decline. Here's what my team does with that soft credit. We pull it, we analyze it, and we call you before you fill out a full application. Because if there's a problem, we can fix it before you waste time on paperwork. If you've got late payments, we coach you on how to explain them. Medical hardship, job loss, divorce, we document it. If you've got collections, we explore settlement options or dispute processes. Sometimes paying off a small collection bumps your score 40 points. If you've got too many inquiries, we tell you to stop applying until we can submit your file. The soft credit pre-screen is how we get you from application to actual approval without the frustration. Banks? They take your application, pull a hard credit, tell you no 3 weeks later. We tell you the problems up front, give you options, get you fixed, then we apply. I've been in the mortgage business since 2003. My team runs soft credits every single day. We've got a system that catches problems before they kill deals. Our average time from application to closing is 14 days, because we're working with good information from the start. In the final part, I'll tell you exactly what to do next. All right, we've covered what banks won't tell you, the 4 loan programs, and how we use soft credits to get you moving faster. Now let's talk about what you actually do next. Here's your first move. Click the link in the description. Fill out the quick form. Takes 3 minutes. Include your email, your phone number when you're looking to buy. We're going to pull a soft credit and call you within 24 hours. No hard inquiry, no damage to your score, just real talk about where you stand. On that call, one of my loan officers is going to walk you through your options. We'll run all 4 programs, FHA, VA, USDA, conventional. We'll show you the actual monthly payment on each one, and we'll tell you which program saves you the most money. Not what the bank pushes, what actually saves you money. That's the difference between a broker and a bank. Once we've got your soft credit pulled and you know which program is right for you, we'll send you the full application. You fill it out. We'll tell you exactly what documents we need. 2 months of bank statements, 2 years of tax returns, your job verification letter, nothing crazy. We start pulling this documentation while your application is still in progress. So by the time we submit everything, we've already got most of what the lender needs. That's how we close in 14 days. Once we get your conditional approval from the lender, we lock your rate. And here's where the broker advantage is massive. I've got access to over 240 lenders. That means if rates drop between now and your closing date, I can shop your file to a different lender and get you that lower rate. Banks can't do that. You're locked into their timeline. I've been in the mortgage business since 2003, worked for national banks, moved to the broker world because I wanted to actually help people instead of just process them. My team runs the Legends Mortgage, powered by Loan Factory. We've got access to over 240 lenders. We've got a $1,000 lowest rate and fee guarantee. You find a better rate with the same terms? I beat it or write you a check. And our average time from application to closing is 14 days. So here's what I want you to do right now. Click the link in the description. Fill out the soft credit pre-screen form. 3 minutes. We'll call you within 24 hours. No sales pitch, no games. Just real information that actually helps you make a decision. We're laser focused on Florida, but we've got team coverage in 48 states. So even if you're not local, we'll get you taken care of. Let's get you into a home in 2026 at a rate that actually makes sense.